Risk-weighted assets. When speaking of capital levels, it is almost exclusively in relation to what are known as a bank's risk-weighted assets. In fact, absolute capital levels mean little on a standalone basis and only become relevant as a portion of a bank's assets as measured by statutory risk weightings. Effectively, every asset of a bank is assigned a measure of risk as stipulated and measured by the Basel Committee on Banking Supervision, or BCBS, and enforced by individual countries' financial regulators. These types of risk are assessed, including credit risk, market risk, and operational risk. Credit risk, the largest and easiest to quantify component, represents counterparty risk, or the risk of a borrower defaulting on a loan from the lender, either the interest and/or capital component. Credit risks are assessed either using a standardized approach that employs external ratings to quantify credit risk, or, as is more commonly adopted by banks, an internal ratings-based approach, as outlined by the Basel Committee. These weightings range from zero risk weighting all the way to full capital deductions. This allows a bank to calibrate their capital levels according to the level of empiric risk held on and off their balance sheets. For an example, assets including cash, currencies, and government bonds will typically carry a 0% risk weighting, whilst at the other end of the spectrum, mortgages, consumer loans, commercial real estate, corporate lending facilities, and so forth are risk-weighted according to internal and external credit scores and ratings, from AAA all the way to C and default categories. Further, holdings in other financial institutions not fully consolidated, i.e. minority interests, must be deducted from said investing bank's own regulatory capital. To demonstrate, using a simple standardized approach, a £100 corporate loan rated AA by external ratings agencies and carrying a 20% risk weighting would thus constitute risk assets of £20. A bank maintaining a 10% common equity Tier 1 ratio would set aside £2 of capital against this £100 loan. Market risk constitutes risk that a sufficiently liquid financial asset is affected by outside market forces, including interest rates, FX rates, inflation, and/or other economic indicators, including unemployment, GDP, or other economic forces affecting the value and liquidity of said financial instrument. This is normally quantified and calibrated using a value at risk model. Lastly is operational risk, which the Basel Committee on Banking Supervision defines as the risk of loss occurring from inadequate or failed internal processes. This can range from anything such as day-to-day running of bank activity, procedural issues such as system failures, robberies, or other issues including fraud or other legal issues.